Conceptual framework. Differences: element GAAP, US-based, IFRS, international-based, origin rule-based, principle-based, governing body, Financial Accounting Standards Board, FASB, International Accounting Standards Board, ISB. Legal environment: strong regulatory enforcement by SEC, varies by country, often less enforcement. Objective: reliable, consistent, and comparable reporting. Understandability, comparability, global integration. Focus: detail and precision, judgment and interpretation. Key differences in accounting treatments. 1. Revenue recognition. Both frameworks now follow similar guidelines due to ASC 606, GAAP, and IFRS 15, but key differences still exist. Criteria: GAAP, IFRS structure, industry-specific guidance, uniform standard across all industries. Contract modifications, more prescriptive, greater flexibility. Performance obligations, more detailed disclosures, requires more interpretation too. Inventory criteria: GAAP, IFRS costing methods, FIFO, LIFO, weighted average, FIFO, weighted average, LIFO not allowed, reversal of write-downs prohibited, permitted if value recovers. IFRS allows for more recoverability, flexibility, while GAAP adopts a more conservative stance. 3. Property, plant, and equipment, PP, criteria: GAAP, IFRS valuation cost model only, cost or revaluation model, revaluation not permitted, permitted depreciation no, component depreciation required, component-based required. 4. Development costs: GAAP, IFRS expensed as incurred, capitalized if criteria are met. IFRS encourages capitalizing development costs under certain conditions, which may increase assets and net income. 5. Leases: under both GAAP, ASC 842, and IFRS 16, lessees recognize right-of-use assets and liabilities, but criteria: GAAP, IFRS lease classification, operating versus finance, all leases treated as finance leases, short-term leases exempt if less than or equal to 12 months. Same. 6. Impairment of assets criteria: GAAP, IFRS impairment test 2-step, recoverability test 1-step, compared to recoverable amount, reversal of impairment not allowed, excluding goodwill. 7. Financial statement presentation feature: GAAP, IFRS income statement, no prescribed format, requires certain line items. Balance sheet: assets equals liabilities plus equity, assets equals equity plus liabilities. Comparative statements optional, except for SEC, required for all reporting. Convergence efforts between GAAP and IFRS. Initiatives by FASB and IASB, 2002, present, joint projects, revenue recognition, leasing, financial instruments. Outcomes: converged standards in revenue recognition and leases, continued divergences in inventory, PP, and financial statement presentation. Challenges of dual reporting. For multinational corporations operating in GAAP and IFRS environments, increased audit complexity, higher reporting costs, reconciliation requirements for cross-border investors, multiple internal accounting systems. Implications for investors and analysts. Valuation disparities due to different depreciation, revenue recognition, and impairment treatments need to normalize earnings for comparability. IFRS permits more judgment, which could reduce reliability if misused. GAAP offers rigid structure, sometimes limiting adaptability. Regulatory landscape and the future. SEC currently requires GAAP for U.S. listings. Foreign filers may use IFRS, without reconciliation since 2007. Globalization pressures may eventually lead to unified standards. Case study comparison: company standard used, inventory method development, cost treatment, Coca-Cola GAAP, LIFO expensed, Nestle IFRS FIFO capitalized.